Your lost crypto could save you $50,000 in taxes, but only if you understand how to properly document and claim these losses. Most crypto investments are doing it completely wrong. I'm talking about coins stuck on defunct exchanges, locked in inaccessible wallets, or lost in scams and hacks. Everyone told you that the money was gone forever, but what they didn't tell you is that these losses can provide massive tax benefits if you handle them correctly. Despite what you might think, lost doesn't automatically mean tax deductible. And the difference between doing this right and doing it wrong could lose you tens of thousands of dollars. Let me tell you why you should trust me with something as important as your crypto tax strategy. I'm with Numeratus, and we're not your typical accounting firm. While most firms are still trying to figure out what a hardware wallet is, we specialize in complex crypto tax cases explicitly. We've handled several crypto loss cases, FTX collapses, victims, wallet recovery disasters, major hack losses. We've helped clients recover tens of thousands of dollars in tax savings from crypto losses that other accountants told them were worthless. We've successfully defended these loss claims in IRS audits when other firms would have just folded. Crypto tax law is so new and complex that 90% of accountants are just guessing when it comes to loss treatment. They're using outdated rules that don't apply to digital assets, or they're so scared of the IRS that they won't claim legitimate losses at all. We built our practice specifically around these complex crypto tax situations. We know the current regulations, we understand the documentation requirements, and we've seen every type of crypto loss scenario you can imagine. If you're watching this, you probably have cryptos you can't access. Maybe funds on a dead exchange, a lost wallet, or you were hacked. You're wondering, can I write this off? And if so, how much will it save me? Here's what I'm going to show you. How to determine if your crypto losses qualify for tax deductions, how to properly document those losses to survive an IRS audit, and how to maximize your tax savings while staying completely compliant. But here's what's really going to shock you. The biggest mistake isn't failing to claim crypto losses. It's claiming losses incorrectly and triggering an audit that costs you far more than the tax savings were worth. So let me show you exactly how to handle crypto losses the right way. Problem number 1, the qualification confusion. Not all losses are equal. Let's start with the basics. Imagine you bought Bitcoin at $60,000 and now it's worth $30,000. You're down $30,000. But from a tax perspective, you haven't lost anything yet because you haven't realized the loss. This is called an unrealized loss, and it doesn't provide any tax benefits until you actually sell the crypto or it becomes completely worthless. Just watching your portfolio value drop doesn't create tax deductions. But now, imagine your crypto was on FTX when it collapsed, or you lost access to a wallet containing $100,000 in crypto. These situations might qualify as realized losses because the crypto has become inaccessible or worthless. But you need to understand the specific rules that apply. Do you understand the difference between unrealized losses that don't help your taxes and realized losses that can save you thousands? Most crypto investors think any loss in value creates tax deductions, but only specific types of losses actually qualify. Here's what actually qualifies for crypto loss deductions. Theft losses from hacks or scams with proper documentation. Worthless securities when exchanges collapse or tokens become completely worthless. Casualty losses in very specific circumstances. Sales of crypto at a loss to realize capital losses. Simply watching your crypto lose value doesn't qualify. You need a specific event that realizes the loss. Now, despite what you've been told, understanding what qualifies as a loss is one step that is by far the most important and yet also the most overlooked aspect of crypto tax planning. But even if you have qualifying losses, there's a critical documentation requirement most people miss. Problem number 2, the documentation disaster. Proof that survives audits. This is where most crypto investors make expensive mistakes. They assume that just having lost cryptos is enough to claim a deduction. But the IRS requires specific documentation to prove that the loss actually occurred and qualifies for tax benefits. Imagine you lost $200,000 worth of crypto in the FTX collapse. You want to claim this as a theft loss on your taxes, which could save you $50,000 plus in taxes. But when you file your return, you just put down the loss amount without proper documentation. 2 years later, you get audited. The IRS wants proof that you actually had crypto on FTX, proof of the value when it was lost, proof that you can't recover it, and proof that it qualifies as a theft loss rather than just an investment loss. If you can't provide this documentation, the IRS will disallow the entire deduction and potentially add penalties for claiming improper deductions. Do you have the documentation needed to prove your crypto losses to the IRS? Most crypto investors who claim losses have no idea what documentation the IRS will require to validate those losses. Here's what proper crypto loss documentation looks like. Screenshots of account balances before the loss event, official documentation from exchanges about closures or hacks, police reports for the theft losses, blockchain evidence showing the lost transaction, professional valuations of the crypto at the time of the loss. You're not just claiming a loss. You're building a case that will survive an IRS audit. After learning the fundamentals, there is one thing that people completely neglect, and it's something that should be one of the most important things to you when claiming crypto losses. It's understanding the different types of loss treatment. Problem number 3, the classification catastrophe, maximizing your tax benefits. Not all crypto losses are treated the same way for tax purposes, and the classification you choose can dramatically affect your tax savings. Imagine you lost $100,000 in crypto. If you treat this as a capital loss, you can only deduct $3,000 per year against ordinary income, meaning it would take over 30 years to fully benefit from the loss. But if it qualifies as a theft loss, you might be able to deduct the entire amount in the year it occurred. The difference in tax treatment can mean the difference between saving $1,000 this year and saving $30,000 this year. But you need to understand which classification applies to your specific situation and have the documentation to support it. Do you understand how different loss classifications affect your tax savings? Most crypto investors don't realize that how they classify their losses can make a $20,000 plus difference in their tax savings. Here's how different crypto loss classifications work. Capital losses offset capital gains in up to $3,000 of an ordinary income per year. Theft losses can potentially be deducted in full in the year they occur. Casualty losses have specific requirements and limitations. Business losses may be fully deductible if crypto activity qualify as a business. The key is understanding which classification applies to your situation and having the documentation to support it. This next step I'm about to share with you is possibly one of the most important things to do when it comes to crypto loss planning, and yet it is one people disregard the importance of the most: timing your loss recognition strategically. Problem number 4, the timing trap. When to realize losses. The timing of when you realize crypto losses can dramatically affect your overall tax situation. Imagine you have significant crypto gains this year from the bull run, but you also have crypto losses from previous years that you haven't realized yet. If you strategically realize those losses in the same year as your gains, you can offset the gains and potentially eliminate most of your crypto tax liability. But if you don't plan the timing correctly, you might pay taxes on gains this year and then have losses next year that don't provide any benefit because you don't have gains to offset. Are you strategically timing your crypto loss recognition to maximize tax benefits? Most crypto investors realize losses randomly instead of strategically timing them for maximum tax benefit. Here's what strategic timing looks like. You analyze your overall tax situation before realizing any losses. You coordinate loss recognition with gain recognition to maximize offsets. You consider multi-year tax planning to optimize the timing of loss benefits. You're not just claiming losses when they occur, you're strategically managing when to recognize them to maximize tax benefits. Now that we have everything we've talked about settled, The next step is by far the easiest process, yet most people overcomplicate it, working with professionals who understand crypto tax law. Problem number 5, the professional guidance gap. Avoiding expensive mistakes. Crypto tax law is complex and constantly evolving, and mistakes can be extremely expensive. Imagine you try to handle crypto loss claims yourself using generic tax software. You make classification errors, you don't have proper documentation, and you miss opportunities to maximize your benefits. When the IRS audits you, you end up paying more in penalties and professional fees than you saved in taxes. Or worse, you're so afraid of making mistakes that you don't claim legitimate losses at all, leaving tens of thousands of dollars in tax savings on the table. Are you confident enough in your understanding of the crypto tax law to handle complex loss claims yourself? Most crypto investors either make expensive mistakes trying to handle complex tax issues themselves, or they miss opportunities because they're afraid to claim legitimate benefits. Here's what professional crypto tax guidance provides: proper classification of your specific loss situations, documentation strategies that will survive IRS audits, timing optimization to maximize your tax benefits, ongoing compliance to prevent future problems. You're not just filing a tax return, you're implementing a comprehensive strategy to maximize your crypto tax benefits while minimizing your risks. This next part can take you from being someone who just accepts crypto losses as part of the game to someone who turns those losses into significant tax advantages. And it's something sophisticated crypto investors do automatically. Problem number 6, the portfolio optimization strategy, turning losses into wealth. Smart crypto investors don't just claim losses, they use loss harvesting as an ongoing wealth building strategy. Imagine you have a diversified crypto portfolio with both gains and losses. Instead of just holding everything and hoping it goes up, you strategically realize losses to offset gains, then immediately reinvest in a similar but not identical asset to maintain your market exposure. This strategy, called tax loss harvesting, allows you to reduce your tax liability while maintaining your investment position. You're essentially getting the same market exposure while paying less in taxes. Are you using your crypto tax losses strategically to optimize your overall tax situation? Most crypto investors see losses as failures instead of opportunities to optimize their tax situation and build wealth more efficiently. Here's what strategic crypto loss management looks like: regular portfolio reviews to identify loss harvesting opportunities, strategic rebalancing that optimizes for tax efficiency, coordination between crypto losses and other investment gains, long-term planning that maximizes the value of loss carryforwards. You're not just dealing with losses when they happen, you're proactively managing your portfolio to optimize your tax situation and build wealth more efficiently. Crypto losses are painful, but they don't have to be worthless. If you have significant crypto losses, whether from exchange collapses, lost wallets, hacks, or just bad investments, those losses can provide substantial tax benefits if you handle them correctly. But the key phrase is, if you handle them correctly. Crypto tax law is complex, the documentation requirements are specific, and the penalties for getting it wrong can be severe. Every day you wait to properly document and claim legitimate crypto losses, you're potentially leaving thousands of dollars in tax savings on the table. Every mistake you make in claiming losses could trigger an audit that costs you far more than the savings they were worth. If you have significant crypto losses that you think might qualify for tax deductions, if you want to make sure you're maximizing your tax benefits while staying completely compliant, and if you want to turn your crypto losses into a strategic advantage for building wealth, you need professional guidance. At Numeratus, we specialize in complex crypto tax situations, including loss documentation and optimization. We understand the specific requirements for different types of crypto losses, and we can help you maximize your tax benefits while ensuring full compliance with tax law. We're not your typical accounting firm. We work with crypto investors who have complex situations that require specialized knowledge and strategic planning. If you want to learn more, about how to properly document and claim crypto losses, how to maximize your tax savings from crypto losses, and how to use loss harvesting as part of a comprehensive crypto tax strategy, visit numeratus.us or contact us directly. Don't let your crypto losses be worthless. Don't assume that lost crypto can't provide tax benefits. And don't try to navigate complex crypto tax law without professional guidance. Because remember, your crypto losses might be the key to saving tens of thousands of dollars in taxes, but only if you understand the rules and follow them correctly.